China and Japan and Brazil range from 1 to 4%. So it's these economies are huge, and Brazil represent 1%, China like 4 or 5. It's very little of the revenues of the S&P 500. It makes the point that you have to have that direct exposure, ideally, for that diversification benefits. And you can see in the MSCI Global Index in how it's composed by different countries and regions. Mostly it's the US, so about 65% is the US capital markets. And then Europe is about like 10, emerging markets about 10, 11. Japan is about 5. And this is from JP Morgan Guide to Markets, a great presentation. And there you can see how in 1987, the US was about 30% of the global capital markets, and now it's 65. So you can say it doubled. Japan was really eye-opening. It was about 40% of all the world's market, and now it's 5%. So the importance of diversification. Yeah. Emerging markets was about 0 to 1% in the 1987, early 90s, and now it's 11%. So you can say emerging markets 10x. This graph shows that every region has its cycle or its time, and extrapolating past success of a region, even if it lasts for a decade, is a behavioral bias. This framework was part of what I studied and saw many years ago while studying for the CFA exam. And then I added a few points such as M2, which is just how much money is in bank deposits, the money circulating, and as well as short-term interest rates, whatever the bank is dictating rate should be. So I added those two to the framework. And for this, tracking these metrics over time, you can see kind of the situation of an economy. So it's important to be aware of them. A big one that you see on the news is deficit, or the fiscal spending of the government relative to GDP. In EM, anything less than -4 indicates credit risk. If you're spending more in the government, more than you're taking in, then if it's at 4, you run a small deficit, I guess it can continue, but it can get larger or continue forever. And then regarding debt to GDP, like gravity, it's a number that just works and it pulls. And in EM, debt to GDP is about, once you reach more than 70% of public debt, it can be troublesome. And especially if more than half of that is owed in foreign currency. Because if you owe it locally, like Japan, then it's a little less risky. But if you owe it to someone else and in another currency, it could be a problem. So that's the deficit to GDP, debt to GDP. And then the third most simple takeaway is higher rates or short-term rates. Higher rates means save, you get paid more, but also means lower asset prices. So bonds fall, stocks usually fall. And then vice versa, lower rates equals just borrow, invest, consume, and that brings up asset prices. In the US, the debt levels, I say it's timely because they're as high as they were post-World War II. And yes, we came from COVID, so there was a lot of spending and debt built up, but we are at very high levels. In perspective, the US spends about $1 trillion in interest payments, just in interest. And it's about the same amount that goes to it's part of the defense budget. In perspective, Social Security is 1.5 trillion, so it's a big chunk that we're paying in interest. On an income perspective, I thought that was interesting. It's more than double than what all US corporations pay in taxes. And and it's all going to just interest. A quick parenthesis on that is everything in the world of relativism, everything is relative. So debt can also be good. If well managed within healthy levels, that can be good, especially at low rates. If you have a cheap debt or a low interest to fund capex, to fund productivity that leads to returns that are higher than cost, that's good. Now, the other side, if interest rates are high and they are higher than what you can expect to make, then no bueno. Well, that's not good if your interest is more than what you can make. And then I guess my call to action is learn about emerging markets, its drivers beyond investing. If you live there, you work there, you have a business there, or you have a friend there, learn about them, what drives it. And then there is research from the big rating companies, but it's also important to do your own work, your own research, and your own critical thinking. And finally, again, you mentioned this diversify among many asset classes, asset types, and consider EM. I did not know this, but I guess it came through that, to doing the framework, to doing the analysis. India stood out, and yeah, that was something that surprised me from my findings. But again, don't extrapolate. Do your own research, and make sure that whatever exposure you decide fits your own personal goals and your situation. And the returns were very interesting. And what really stood out was the risk, or the volatility was not as high as I would have thought. But again, that's past performance. Do your own work, your own research, and yeah, something that see what fits your own goals. The views here and opinions expressed are my own and provided for educational, informational purposes only. They do not represent the views of Insignio, and nothing here should be considered investment advice.